Welcome back to Financial Design Studios channel here. My name is Trevor Meyer. I'm excited to be walking you through pensions and figuring out what are those little variables that we need to be mindful of as we go through what's going to make the most sense for you and your financial plan. If I were to ask you whether you would be better off receiving $50,000 a year for the next 30 years or $800,000 today, do you know what you would choose? The right answer for you may depend on a number of different factors. There's a financial best answer, which even then it depends. And then there's also the family or behavioral best answer. Because we all know that some of us, if we had $800,000 today, may not make the best and highest use of those funds. So it might be better to actually spread this out over a longer time period. Now, let's assume that we are making wise financial decisions with our money, and we need to determine what's going to be the most economical or the best financial answer as we're trying to troubleshoot and figure out what's going to make the most sense. The way to determine what option is going to be better for us comes down to a term called net present value, or NPV. Essentially, this is a formula that looks at two different options. One, it looks at this lump sum, and it also looks at all this payment stream. And based on a specific discount rate, it'll bring all these values back to today's value, and all we have to do is pick the highest one, right? So if we know we have option 2 of the $800,000, we know if we bring that back down to today, well, we received it today, so we're still at $800,000. If we look at the $50,000 option, where we receive that for 30 years, that's a little bit more challenging because we can't just simply take $50,000 times 30 years, because that's going to work out to $600,000. In reality, some of that $50,000 is getting invested. We're being wise with our funds and we're preparing for the future with this. So if we apply a discount rate to this value of roughly 5%, we actually work out to a number that's very close and similar to the $800,000 from a net present value perspective. Now let's say we actually don't need to go through the math. Let's just say that we know that this lump sum option today isn't going to be the best financial answer for us going forward. So if we cross all this out, we're going to be left with just the $50,000 option. Now that's just based on one thing. That's based on your single life annuity amount. So that's often referred to as an SLA. Generally speaking, these annuities aren't going to pay just for 30 years, they're going to pay for the rest of your lifetime. So we have to take into account how long you anticipate to live, but we also need to take into account, are you married? So if you're married, one of the things that we need to ask and think through is to say, well, let's say we take this single life annuity based solely on your lifetime, but unfortunately something happens to you just a couple of years into your retirement. As you're taking this pension, what happens to that money? That money goes away, and we don't want that to happen for you and your spouse, because that's really bad news for your entire financial plan. Now, if you are married, one of the options you should have available to you is to convert your single life annuity into what's called a joint and survivor option. It's worth mentioning that generally speaking, this payment will be less than your single life annuity because the annuity company, whoever picks up the annuity, or your employer if they're going to self-insure it, will generally be expected to pay out for a longer time period, right? These are all based on actuarial figures, how long we're expected to live, and when we're insuring two different people, it's going to be a longer time period than if it's going to be a single person. Therefore, if it's going to be a longer time period, our benefit amount is going to be less. So instead of $50,000, we might be looking at $45,000 a year. These are just examples. Every case is going to be different. Every insurance company or every employer is going to have their own specific numbers to apply specifically to your pension amount. So we've talked a little bit about how to calculate the best pension election available to you. One of the questions we oftentimes get is, how do pensions interact with your 401k? So this is the more common retirement benefit that we're seeing from employers nowadays over the last 20 or 30 years as these have surged in popularity. Now, why have they surged in popularity over pensions? 401ks, frankly speaking, are generally cheaper for an employer to administer and manage than a pension would be. And the math is pretty simple here because a lot of times employers may be expected to, front out a pension for an employee for 30 or 40 years of retirement, which sometimes can be even longer than when they were actually working for. As opposed to a 401k where the employer just pays a set percentage of your pay, oftentimes as a match or a safe harbor contribution, directly into account for your benefit. But then when you retire, the employer is not required to pay any more additional towards your retirement. All that onerous is back onto you. Now let's say that when retirement comes, we have both a 401k and we have a pension amount. What do you need to do, and what are the things you need to do? What do you need to do to make sure you're making the most of both of these benefits available? It's not uncommon for us to see clients that have a pension amount also have a 401k. Well, we can look at the pension and see, do we want to convert that to a monthly income stream? What we were talking about before. Do we want to change that to it's going to be $50,000 or maybe $45,000 a year if it's a joint and survivor annuity? Conversely, we can take this 401k amount and move that into an IRA so that we don't have to keep that at our employers any longer. We can actually put that into an IRA and we can self-manage it. We can pick up investments that are most applicable for you so that you have the most flexibility available to you. You're living off this $45,000 plus whatever distributions you need to take out of your IRA. Now let's take a step back even further. What about the taxes associated with all of these? Generally speaking, if we move this pension amount into the IRA, which is one of your options, it won't be a taxable distribution. In other words, if we go pension into the IRA, that means no tax. This is called a rollover contribution into your IRA. Now, what if we take this pension as this $45,000 distribution as a joint survivor payment for as long as you and your spouse are living, you would actually receive this $45,000. As we're looking at our tax return each year, normally we will have to include this $45,000 as taxable income. Depending on your state, it may or may not be taxable in your state, but it oftentimes will be included for your federally taxable income or be reported on your 1040, your federal tax return. That's one of the things to keep in mind as we're looking at different planning scenarios. If we want to maintain a tax planning window to reduce taxable income in certain years, we might want to look at the IRA approach of rolling it in there rather than converting it to the income. Just another one of the little variables, one of the planning considerations we think about as we're evaluating pensions and what's going to make the most sense for each individual client. Thus far, we talked a little bit about the financial implications associated with a pension decision. We've also talked about some of the coordination aspects with your 401k and the taxability aspects of what's going to happen when you retire, taking distributions from these funds. One of the final things I wanted to talk about here today is how do you go about getting this information? Because as you near closer to retirement, you have to make an intentional choice decision of what you want to do with any pension that might be available to you. As a reminder, it is completely on you to get this information ahead of time because there may be a default option provided through your employer that you may or may not like. So, as you're looking for this information, one of the things you need to do is to request a quote for what these single life annuity, what the joint and survivor annuity, and what any lump sum options might look like. Oftentimes, this is going to take the form of a table. So I'll draw out a option table like this. And we'll basically have two kind of things here. We'll just say what the option is and what the payment is. So this will take the form of a table like this. We'll oftentimes see a single life option. And if we're married, we'll also see some other options. If you're not married, this single life might be the only available option. So let's say from our prior example that we hit $50,000 a year, but instead of 30 years, this is actually going to be reported as the rest of your life. The other option that we can look at is a joint and survivor or J&S. And this is where we're looking at that reduced benefit typically. Another option that you might see or you might be familiar with that might show up is a 10-year certain. So let's say that you take a single life annuity option. You can also choose to say, hey, I want single life, but I want to make sure that even if I were to die within, let's say, the second policy year or the second payment year, that payments are going to continue for the next X number of years. So this is oftentimes described as a single life plus 5 or 10-year term certain. Now this, because the insurance company or the employer is going to make sure they have to pay out more than that, they can't use their true actuarial tables, this again will likely be smaller than the $50,000. Let's say, for example, this example is $47,500. So understanding that, how that coordinates with our financial plan will be important to know as well. There might be many other options available to you. It's important to look at this whole table, evaluate all the options in unison, and determine what's going to make the most sense for you and your family. One of the common recommendations that we will encourage is, if you are married, do not look at the single life annuity option, because if something were to happen, your spouse, generally speaking, will not receive any of these funds, and it might be a wasted benefit. So at a minimum, we would probably encourage you to take a look at this joint survivor option, or maybe the lump sum option if that is an available choice to you as well. There's a lot of detail associated with pensions. There's a lot of information, and there's a lot of decision making that has to be involved. If you have a pension, you have a lot of questions about it, you're not sure how to make the most of it, please let us know. Reach out. We would love to help walk you along that. We have a lot of other videos about all things related to finances and financial planning. If you're curious to learn more, please click around, take a look at some of the videos. If you want to know even more, or you're interested in having someone come alongside and help you with some of these decisions, let us know. Reach out. We would love to help you and be a guide as much as we can. Thank you.